So in the prior decade, QE was intended in part to suppress yields, right? That it was one of the tools that they were using. But when actually people crunched the numbers, they found that at the time of purchases, that was not the case, that you'd actually have an environment of yields going up. And the way I like to structure it, the way I frame it at least, is there's a difference between long term and short term, right? So the short term is that, when they're not buying, financial conditions are tighter, economy's slowing, financial markets are tighter, and a lot of risk assets are not doing great, and people buy bonds. When the central bank starts buying, it reliquefies the market, it eases financial conditions. You see, get an uptick in risk assets, people buy those and they sell the bonds. So even though the Fed's buying, central banks are buying, the private sector is selling. They're saying, okay, sold to you. And so in the near term, it actually has the counterintuitive opposite effect. People wouldn't expect it if the biggest buyer buys a product, the price goes down, yields go up. You would not expect that, but that's how it works. But if you zoom out, the question is, let's say the Fed wanted to sell $2 trillion in treasuries that decade. Could they have done it without destroying the price? I would argue, and many would argue, no. That they're basically that even though the moment they buy it, it's actually not the price actually you'd expect. That the cumulative effect of taking that excess supply off the market was important for holding down yields. And now that we're seeing more inflationary pressures and we have debt at higher levels relative to GDP, and there's just supply glut of those bond issuances, a lot of people were insisting that, once the central banks try to tighten, that's not bad for yields. But if you were actually doing supply demand analysis of who's gonna buy that, who's so much of it, who's gonna buy it, right now we're in an environment where yields are going up as the central banks have in many cases pulled back their purchases. And so that's more in line with intuition. And I think that's more in line with the fact that we have an inflation environment and we have more acute oversupply. And actually, that relationship started breaking down in March 2020 because, during the COVID crash, first it went how you'd expect, which is people sold stocks and they bought bonds, right? They're like, okay, we don't know what's going to happen. Let's get into treasuries. And then it got so bad and the dollar spiked because all these cash flows around the world are drying up, but they still have dollar denominated debt to service. So there's a scramble for dollars and safe haven status. So everybody's scrambling for dollars. And then the problem is that countries with dollar denominated debt, they have to sell assets to get dollars to service the debt. So what do they sell? They sell treasuries. And so basically people bought treasuries, they sold stocks until it crashed so hard and got so illiquid and the dollar spiked so much that they forced sold treasuries and it broke the treasury market. The off the run treasury market went totally liquid. There's like no bid. And you actually started to get yields spiking from a very low level at the worst point in that sell-off, which is when you think there'd be maximum demand for treasuries. And that's again, it's a mechanical supply demand problem at that point. And so that's when the Federal Reserve had to come in and buy $1 trillion of treasuries in 3 weeks. And they hammered down that little spike and they fixed the liquidity situation. That was kind of the first sign of a trend change, that this is not the 2010s situation. This is more a sovereign debt crisis situation. It's different. And that's really materialized here in 2022, which is, we've gotten past, I think, that disinflationary commodity oversupply cycle that, was I've used the analog of the 1930s compared to the 2010s, just without the Dust Bowl and with better technology, so it's more fun, but it's still kind of this stagflationary deleveraging period. And now we're in the 2020s, which is unfortunately more like the 1940s, which is massive fiscal spending, rising geopolitical tensions, outright war in some cases. Unfortunately, the analogy got more literal than when I originally made that analogy. And that's a more inflationary environment, and that's an environment where stocks and bonds could go down together if the central banks are not monetizing that debt because they have trouble placing that debt. So right now you have, as long as the dollar is strong, foreign sectors not buying treasuries. In fact, they're trimming their treasuries to defend their own currency. It's not that their opinion is that treasuries are, overvalued. It's just a mechanical outcome. It's like, hey, we want to defend the yen. We're going to not buy treasuries. We're going to trim some treasuries. That's how it is. Then you have Fed's not, they're letting treasuries mature off the balance sheet. And you have SLR regulations, meaning that commercial banks can only buy so many treasuries. So if the three biggest balance sheets are net flat to down and there's still issuance, then all these like smaller balance sheets have to absorb them somehow. And that's how you get disorderly liquid conditions with higher yields and lower prices. And so I think that 2020 is just marked by sovereign debt problems and currency problems. Not necessarily the prior one was all, it blew up in the banking sector and the private leverage sector, whereas now I think it's more sovereign debt, currencies, and then that underlying energy input because you can't print energy. It's a good set of questions, and I have different answers depending on time frames or how fundamental I am in my thinking. Which is, my kind of bedrock answer is that I'm not a fan of price controls, and that includes the price of money, right? So I actually kind of contest the whole notion of the way modern central banking works. The United States is a country of 330 million people. Do I think that there's one interest rate that is suitable for the entire country? Is the interest rate for rural Alabama the same rate as New York? Um, and should this be set by a small committee of elders, right? So I would say no, right? So I kind of just in some cases throw out the model, but that is the model we live in. That's the model that we operate in. So then the question becomes, what do you do with that model? So I think if Powell's trying to optimize for inflation, which he's actually kind of legally mandated to do, right? He's got really three mandates. One is um, low unemployment, which he's got officially, the way they measure it. Then it's stable pricing, which they define as 2% average inflation. They're currently way above target, the way they measure it. So he's got to get that down in terms of mandates. And then they have kind of the third shadow mandate of financial stability. So if the treasury market blows up, they have no choice but to go in and fix that before it melts down, right? So he's he's got a clear mandate, which is increase unemployment and decrease inflation. So I think using the limited tools he has, he's kind of forced to do what he's supposed to do. Um, so I'm not really sure what I would do different if I was Powell, because I think it's almost an unsolvable problem. It's like, how do you give advice to solve an unsolvable problem, or kind of a bad algorithm for what you're supposed to do? So in general, I think in this environment, only solving for inflation is the wrong problem, and instead it's how to get disinflationary growth, which is mostly not a central bank question. It's mostly a private sector and fiscal policy question. It's mostly how do you get more energy supply? How do you get more infrastructure, right? That kind of thing. And that's not something Powell has any control over. He's even said we have no control over food and energy prices. So that might be even a hint at average inflation targeting if if they just can't get the energy situation under control and they're like, well, we killed rents at least, so it's the best we could do, right? So I think there's only so much any central banker can do. It's the Kobayashi Maru for people that know Star Trek, right? The unsolvable situation. And so I think that's kind of what they're in. And the only way around that is probably eventually to change some of the mandates or to redefine how you interpret the mandates, which can include things like just different levels of inflation targeting. And I think, but the longer term story is I would like to see better technology so that there's not like, a committee of like, a handful of elders setting an interest rate for 330 million people in kind of a manual process. I mean, you see things like they do interviews, and they're like, well, we're going to pencil some interest rate hikes in, and it's like, that's how we're running. We're in the 21st century and we're penciling interest rates, we're penciling in basically price controls for the price that sets all other prices. And so, different answers for different time frames, I guess. But I feel bad for Powell. I don't know what I would do differently.